The best entrepreneurs have a massive chip on their shoulder, something they really want to prove. I'm here at Upgrade's headquarters in downtown San Francisco to talk to founder and CEO Renaud. Renaud is one of the OGs of fintech. His life's work has been proving that you could build a great consumer fintech company. In 2007, he founded Lending Club, a pioneer in online lending. In 2014, that company went public, valuing them at $8 billion and helping put fintech as a category on a map. Unfortunately, public markets have not been so kind since, and in 2016, he was forced out. But he got right back at it, founding Upgrade to prove that a great company could be built in this category, but it needed to be done differently. Today, Upgrade is worth more than Lending Club. They have 5 million consumers as customers, and they will originate $10 billion in loans this year. We'll talk about what he did differently this time, and also what the future of consumer fintech looks like. Should be a lot of fun. Looking forward to this conversation. So one of the best reasons to start a company is revenge or having something to prove. So why is it that you decided to start Upgrade after Lending Club?
For sure. Yeah, no, I wouldn't say revenge, but certainly a sense of unfinished business.
Yeah.
I think at Lending Club, after the IPO in like 2014, 2015, we're still growing very fast, but starting to sort of diversify the sort of product lineup. And we were really at the beginning of that, and there was so much potential. It felt like if I was not going to do it at Lending Club, I should keep doing it somewhere else.
Yeah, and Lending Club does consumer online installment loans. You took a piece of that, but you tried to move more from a transactional to relational model.
That's right, and I guess another reason to start a company is a unmet consumer need.
Yeah, that's a good one too.
And I think we really saw that. So in addition to all the credit products we had in mind,
yep.
We felt like there wasn't really a good sort of mainstream sort of neobank fintech
yep.
play in the US. And so there were neobanks starting, already getting to scale
yep.
in this sort of unbanked, lower income, lower
yep.
credit category.
And they all started with banking, but no credit. And actually today still right. mostly don't have.
That's right. And in that part of the credit spectrum and demographics, it's hard to make credit work totally. by definition. But if you focus on a more mainstream consumer, yep.
Then
you can really use credit as a monetization engine and make it all work. And so we felt like there was this opportunity to really build a neobank that would focus on sort of checking and savings accounts as the basics, but then use credit products to monetize and make the economics really work.
Yeah, and I feel like today there's this narrative that consumer or lending are out of favor, but to your point, there's an unmet consumer need that hasn't been built. So talk about how you combine kind of the BNPL or the installment loan product with the card product.
So I think today, I mean, we really have sort of two sides to the business. There's the sort of direct to consumer with sort of mobile banking, credit card, and installment loans.
Yep.
That have like a lot of synergies between the different products. Where mobile banking helps us get more people on board. So get more data for the customer.
That was launched around 2020, a few years after.
That's right. Yeah, we started with personal loans, then credit cards, and mobile banking. I think there are some benefits in doing it in that order, which is unusual. But building that sort of credit piece first really helps you build up the servicing and start building up data and a track record of credit that will help you even raise a lot more capital.
Yeah, that's key. If you had started with credit 3 years later, it takes a long time to build the data and the underwriting and the insight.
That's right. I mean, you're trying to sort of originate billions of, like this year, we're going to probably originate about $10 billion in credit. You can't do that from scratch. You need to build a track record, and there's a slow build there.
Yep.
So a lot of synergies between mobile banking, credit cards, installment loans. Even the credit card and installment loans are a very different use case, whereas often consumers take an installment loan to refinance an existing credit card. So that takes care of all the spend that already happened, but that doesn't take care of future spend. So if you get a credit card, then that takes care of the future. So you get the past all sorted out. You refinanced a revolving debt into a more responsible, sort of amortizing fixed rate debt. But then you still need a credit card for the future. And the way we built the Upgrade card is really as an installment card. So it's a product that's already pretty responsible, pretty easy to budget
talk
for.
specifically about how the upgrade card as an installment card works, because that's combining two seemingly disparate things. Like credit cards, you think revolving; installment loans, you think installment. Like, how did you put the two together?
Yeah. So we've been at it for a long time now. Right? Lending Club started in 2007, so it's been 17 years.
Not that you're counting.
I mean, it's a gray hair to show it. But we've been trying to solve that credit card problem, like refinance existing credit card balances for 17 years. When I started, there was 900 billion in credit card receivables.
Now there's about 1.2.
Now there's 1.1, 1.2 trillion. So either I'm not doing a good job, or it's a really hard problem.
Yeah, or the market has gotten bigger and the opportunity to solve it.
I mean, in the meantime, between these two companies and all the other players that followed, we probably refinanced around 200 billion in credit cards. So it's not nothing. But balances grew faster. And so we thought, okay, what would be a more consumer-friendly, more responsible way to obtain credit card debt? And we thought about this installment card product that really gives you all the benefits of a credit card. You can use it in store or online to make payments. It comes with a credit line. But at the end of each month, the balance on the line turns into an installment loan that pays down at a fixed rate with fixed monthly payments. So you're actually getting out of debt every month. Unlike traditional credit card where you just kick the can down the road and
a traditional credit card, you get the statement, and the big thing is the min pay, which basically means you revolve and it grows.
Exactly. And you pay the interest, but exactly. You don't not really amortizing the debt down.
And so everything amortizes on the upgrade card.
Which led to $1.1 trillion in credit card debt outstanding. And so we thought, okay, let's do this installment card. It will be a more responsible product. And it was a bit of a leap of faith because be responsible is not a great marketing slogan. But so we took it from the angle of...
And the leap of faith too, consumer lending is hard generally. No one had really built a new multi-product solution for a long time, maybe ever, depending on how you look at it.
There was no big fintech credit card platform that would provide a template. So we really built it up from scratch and took that leap of faith. And instead of taking it from the angle of be more responsible, which is really the outcome of that product, we took the angle of lower the cost of your debt. Because you're going to be paying down every month, you pay less interest over time. So I think that angle really resonated with a lot of people, and then the additional benefit of being more responsible and maintaining a better credit record and credit score along the way as an additional benefit.
Yeah, absolutely. And I want to talk about in this conversation, innovation along the product front, distribution front, also capital markets, some other things. But let's keep going deeper on the product, because as we already talked about, started off with a core card, the upgrade card in 2017, did the bank account in 2020, and then you also now have the One Card. So how is the One Card different from the upgrade card?
So with One Card, we really built innovation on top of innovation, where the upgrade card was already a pretty innovative credit card structure. But then we started thinking more about debit and credit, and it felt to us like a lot of these product decisions driven by either the existing infrastructure available at the time or the way banks think about the world. And maybe now is a good time to take a blank slate and think of it from a user perspective. Do I really need two cards, debit and credit? Or is it just a different way for me to allocate expenses and I can do it with a single card? So that's really what One Card is. It's a single card to handle all your expenses. So you have a single card in your wallet, single card on your phone. And you can go to the app and toggle pay now or pay later. So pay now would be the type of expenses you typically use debit card for, so smaller expenses. You want to settle that with your existing bank account. And pay now would be the more credit card functionality.
Yeah.
And you can either toggle for every expenses, or you can like set some rules and say anything more than $200, spread that over 6 months or 12 months. And so we think that's a better way, a simpler way to manage your expenses, because you end up with a single statement and you have like everything in one place. But there are also some economic benefits.
And this is the business model side of the product
in terms
as
of
well.
both business model and some of it we're just sharing with the user, so it's also economic benefits for the consumer. But the way that the card is built, it's essentially a credit card with a sort of automated settlement against a bank account every day for those expenses that are pay now expenses. So since it's a credit card, set us with a credit rails, it's using a credit bin. All the expenses hit the credit line first. We get credit.
Even the pay now expenses.
Even the pay now, like the entire flow of payment. So we're getting credit interchange on it. It's like 2.4% instead of 1.4. Which means we can give better rewards to the users, or we can make the product more profitable for ourselves, or a bit of both. And we also have the type of like credit card benefits you don't get with debit cards, right? So like fraud protections and all these other additional benefits. So I think structuring it that way was a great innovation in terms of user experience, economics, and a business model for ourselves.
Yeah, absolutely. And now you have the banking account and then the one card that is basically credit and debit all in one. Curious what the whole bundle affords in terms of opportunities, like the advantages having the banking account associated with the card means for you, for underwriting, for other product.
Right. Yeah, I mean, at the end of the day, I mean, that's how you were talking about a relational relationship with the user. At the end of the day, I mean, that's what relationship banking was, right? The bankers were able to do more for you if you had all your bank accounts and they had your auto loan and your mortgage, and they would know you and know your family and know your what your need and resources were. So I think we're getting to the same place where we really with the bank account, we have transactional data, we have easier way to verify income.
And transactional data is real time. Credit bureau data is lagging. So if you're extending credit, you can make more informed decisions.
Right, more informed decision at the time of underwriting, but also ongoing decisions, right? In terms of managing the credit line, if there's a credit card, or even in terms of servicing. You can see if there's an NSF, the person is starting to sort of have some friction in terms of either income decreasing or the expense rate going up. So it's so much information we can use for both underwriting and servicing. Also for marketing, we're sort of better situated to understand sort of the next potential need that way. So lots of synergies.
That's great, and good to understand the product. I also want to talk just a little bit about your customers. We touched on them briefly, but who are your customers and what do they look like? You've got about 5 million, I believe.
Yeah, so I mean, we try to design products that are appealing to the broadest swath of the US population. And so we have multiple products, like for example, credit cards, there are different rewards programs and different fee structure. So we have like higher rewards that are like more transactional type of credit cards that are more appropriate for the high end of the market. Some different structure for near prime, and also
you have like a secured card for people who maybe you can upgrade into.
Exactly. I mean, and that's part of that synergy between sort of mobile banking and credit card. I mean, we realized that actually few of the mobile banking customers would qualify for a credit card, especially now as we've all tightened credit and so on. So we came up with sort of baby steps between sort of rewards checking and credit card, where if you don't have a credit history, for like younger consumers or recent immigrants, the entire population, we have a secured card, and I think it's a good secured card, right? It has no fees. There's a clear path to graduation from sort of secured to unsecured or partially secured. And so it's we're trying to make that product really helpful in terms of not like trapping you into that secure product, but really using it as a ramp to a better product that would be more helpful. And we have sort of all kinds of products like this that sort of help us so very mainstream at the end of the day, and have the right product for each part of the credit spectrum.
Yep.
So our averages are very similar to the population average. Right?
Yep.
Average consumer age is like 42-year-old.
Yep.
Average FICO is 700. Average income is about $100,000, which is higher than the average.
Yeah.
When you run some credit products, it has to be.
Yeah, I don't think a lot of folks appreciate the extent to which, the Upgrade consumer audience is very different from a Chime or a Cash App, which are great and serve populations with their own needs, but it's a different core consumer.
Yeah, we have a customer base that's more mature and higher income than a lot of the other fintech companies, and more similar to banks.
Let's talk about distribution, and we'll get into capital markets. So distribution, product innovation is great, but you've also got to get it in front of customers. So how did you solve for distribution? Was there a silver bullet, a lot of lead bullets?
Yeah, I don't think there's a silver bullet in distribution. So I think we think of distribution very different from product. So product, you want to concentrate your resources into like making one thing like really great.
Yeah.
And then have like a few sort of, variations of it. I think distribution is kind of the opposite. You really want to go broad and try as many different things as possible, and run as many different channels as possible, especially if there's no correlation and you can reach a broader audience that way.
Yeah. So the core idea is actually having an experimentation framework that allows you to try channels. And you've probably tried television. Direct mail is something that people have like known you for, although you argue that's only just one strategy, and I'm sure you've tried other things.
Yeah, for sure. And then really distribution runs the gamut of every sort of online and offline, sort of traditional and more innovative type of media. We found that when you have more innovative products, it's useful to have a little bit more time to provide context and sort of explain how the product works a little bit more. And
something that's hard to do on a billboard. Usually it's hard to do in a very short like Instagram thing, but maybe you can do on television or other medium.
Exactly. Yeah. So it would be hard on if you're on like landing tree and there's like a range of products and you have whatever 60 characters to tell the story. But television, for example, when you have like 15 or 30 seconds to sort of pique someone's interest and tell at least part of the story. We found it easier, and so television is like whether it's streaming or even cable has sort of worked surprisingly well for us, so better than we thought it would. I think partially because of it, because we can tell more of the story, explain a bit more why the product is different and why.
And I've talked to Ken Lin at Credit Karma. That was the big unlock in 2014 for Credit Karma, was discovering and stumbling upon some stuff in television, and that's been one of their main channels. Whereas for you guys have diversified channels.
That's right. And it's also a way to either reach a different audience or reach them at a different time, where they're maybe like less busy and more sort of willing to think about this kind of product.
I think this is one of the interesting things investors will struggle with at the very early stage is if you tell them, what's your distribution strategy? It's like, try lots of things. But then again, if you've done it before, that's much easier to believe than if you're starting from scratch. So that's great to just understand experimentation framework for distribution, trying lots of channels. You've also done some pretty interesting things on the capital market side of the business. You're a lending business. That means you need balance sheet, not necessarily your own, but from someone else. Talk to me about how you started, and then also some of the innovative things you're doing today with credit union.
Yeah, and it's something we don't like talk a lot about, but in credit, it's really like literally half of the business, right? people who need the money, but people who have it, and so you're trying to match these two.
And for scale, you're going to do about 10 billion originations this year, and have done about 30 billion over the course of the history of the business. So that's a lot of capital markets relationship.
Exactly. And so I think one of the most sort of innovative things we've done in terms of capital formation was really tapping into a less known source of capital, and that's credit unions. So credit unions are sort of small banks that are non-for-profit, designed to operate really for the sole benefit of their users, of their members. And so because they're non-for-profit, their cost of capital is lower. Right? They don't have.
I think it's a secret. It's kind of an open secret, but not that many people actually know or talk about this,
Right.
that credit unions are growing market share in many categories
Right.
and functionally have a lower cost of capital
Yeah.
because of their tax status.
That's right. Yeah, it's
Yeah.
low cost of capital, so they're tax exempt. So certainly, if you can tap into that capital, that's great. Tapping into that capital is harder because
and it took you did not do this from day one. You did it.
Right. Well, we tried from day one, but it took a long time.
You have to build the
there.
relationship.
Yeah, it took a long time to get there, and credit unions can only sort of buy loans from other credit unions or make loans to their members exclusively.
And was that an insight you borrowed at all from your lending club days where you tried to do this, or is this something?
A little bit, yeah. I think we've been sort of thinking about credit unions as a source of capital for many, many years. It's just hard to do and hard to get started. And so we had to design this memberization process where we sort of applicants become members of the credit union on the fly.
Yeah, absolutely, because they can only serve members.
Right. Yeah. A little bit of technology to build and a process to establish and then sort of confidence to build and relationship to build with credit unions.
Sometimes great ideas in fintech only take 10, 12, 14 years to bear fruit.
No, it does take time, especially when you need to convince partners that are not the most of technology sort of aware to start with, but then are sort of developing their own understanding of what they can do with the technology. So that eventually worked out. We have now sort of hundreds of credit unions that are also buying loans from us, and we benefit from that lower cost of capital and pass on lower cost of capital to consumers. So they benefit from lower cost of capital.
Everyone, but there's the consumer, the credit unions, and then also you. In this case, the credit unions, you gather deposits and can also offer them deposits for the funding.
That's right. So what started to happen 18 months ago is sort of interest rates started going up. It became hard for small banks and credit unions to attract and retain deposit. They were sometimes not sort of increasing their own rates as fast as the rest of the market was moving. Then you got on top of that the sort of SVB crisis that started to make people less confident about smaller banks, and so that accrued more of the deposits to the big sort of money center banks. So it became harder for a lot of our partners to have these deposits to put to work. So we decided to set up an entirely new process again that really sort of leverage our own sort of national brand and national footprint to raise deposits online. So we started with a high-yield savings account, so we can raise deposits online for the benefit of our credit union partners by sweeping these deposits sort of daily, and really establishing this process where we almost like recreated a banking system on our own, where so instead of matching assets and liabilities within a single balance sheet like banks would match assets and liabilities at the network level. So we have 200 banks and credit unions. Some of them need deposits, some need loans, depending on their own loan to deposit ratio. And we could sort of allocate loans and deposits differently depending on their needs. And so and when you sort of optimize at the network level, it's always more efficient than optimizing in your own balance sheet.
Yeah, and this capital markets innovation is very interesting. It took a long time. I think a lot of people do know who Upgrade is. I think they underappreciate the extent to which it's different. I think very few people actually understand the extent to which you've built a very unique capital markets operation, which is not sufficient on its own, but incredibly powerful when you embed it into the product, the distribution, and all of that. So very, very interesting story. Want to touch on two. We talked about product, and I said we'd come back to this. Today you have the bank account, you have the one card, credit and debit, but recently you've gone from having an average of 3 products to 1.6 or nearly 1.7 products across your customer base, and you have some pretty bold visions around moving into other areas. So talk about some of those adjacencies and new areas you'd like to build products, but also other areas you've actually launched recently.
Yeah. So we really want to help our customers with everyday needs, and that's credit, debit, checking accounts, but also in big sort of life events, right? So that require credit very, very often. And so we started building this more sort of merchant networks type of product with sort of home improvement, auto.
A big expense, but not something you typically put on card or can easily get a loan for.
Exactly. It's kind of like in between. If it's like a $20,000 kitchen renovation, big much for a credit card, and really credit card rate would be expensive for that. Maybe it's not enough to take a home equity line of credit.
Yeah, the contractor probably may not accept card, and they probably don't want to accept card because of the rate.
That's right. Yeah. And so we set up this like home improvement financing platform that started about 18 months ago. Has been going really well. We now have thousands of contractors. Going to do about $1 billion in home improvement financing this year. So really ramping up nicely.
And how did you source contractors? Like, what were there nodes within a network that allowed you to acquire multiple, or is it more acquiring?
I think it's really a combination of like some sort of franchise brands that have like hundreds of contractors, and also more of the long tail of independent contractors.
You probably ran some experiments with both to see which
exactly,
worked,
and with the pros and cons, you can imagine certainly more sort of distribution efficiency with a franchise network. But less pricing power there.
Yep, and operational overhead along different dimensions.
Right. And with independent contractors, certainly more pricing power, but also more fraud risk, and all these things you need to think about in terms of home improvement financing. Where if the customer is not happy with the result, they're going to be less likely to pay the loan back, even though it's two different entities.
Yeah, totally. It's kind of but in your consumer's mind, it's very related.
Exactly.
So you actually have to underwrite the contractor.
Like, I'm not paying for it.
Yeah.
Right. So you need to be very careful about sort of aligning with contractors that have good reputation in terms of finishing up the work and so on.
Yeah. So home improvement 18 months ago.
So home improvement.
Mortgage, auto.
Yeah, so mortgage, one area we're not in yet, but that's certainly in the cards. Auto, like buying a car is obviously one of these big expenses. And all of these things are like big expenses, but also emotionally charged moments, right? It's like, it's a great opportunity to build brand attachment and emotional relationship with our customers. If you help them buy the car they want or help them sort of renovate their house, it's like things that they remember. So we launched a sort of indirect auto platform last summer. Going well. We're about close to 500 dealers. And sort of expanding pretty quickly. Goal is to get to about 2,000 dealers.
Yeah. And you said indirect. So in this case, the consumer getting the auto loan does not have an existing relationship with Upgrade. So is the goal to convert them into multi-product customers, and how is that?
That's right, and that's how you sort of increase that penetration and that number of products.
And same for home improvements, where they may or may not be.
Right, and most of the time, I think these like indirect businesses or great sort of acquisition mechanism. And once you've made that home improvement loan or that auto loan, pretty easy to, and you know a lot more about that customer, and you can sort of offer a credit card or checking account. And really have sort of synergies going in that direction for sure. In the other direction, when we talk to dealers and tell them, hey, we have 5 million customers and like 20,000 of them live in a 20-mile radius.
Yeah, you can do targeting.
That's also very attractive for them. So clearly a lot of synergies both ways. And then in the summer last year, we also acquired a BNPL company in the travel space called Uplift. That has a lot of relationships with airlines, cruise lines, hotel chains, and is providing sort of financing for
those are aspirational, medium ticket, smaller than a home improvement loan, but still in the thousands of dollars.
Right. Still, they are still more expensive than the typical BNPL product, and so more in playing to our strength, where it requires more underwriting than
Yeah, there's some interesting things around travel though, right? Because you can actually have them start paying before they get the product, and you have some security there.
That's right. So I mean,
so it's more like pay now, buy later, but amortize, which works in some ways for all parties.
Yeah, no, it works great, and I learned a lot about the cruise business over the last 6 months. So for example, in cruises, I mean, the cruises have been like very popular post-pandemic, pretty much all the cruise lines are like so sold out for the next 2 years. Like Carnival, one of our big partners, is selling like 2026 cruises right now.
Yeah.
So by the time you get on that cruise, you've already paid for the trip. But allowing a customer to pay over time is like a great payment facility. But then there's pretty much no credit risk, because if you haven't paid, you're not getting on the ship.
Yeah, which is very interesting. Large ticket item, and you actually have secured interest in some degree,
in some way.
On your frame. Yeah, I think it's interesting to think about the evolution of consumer fintech companies, because they start off with product innovation, some distribution innovation, but then especially both the products, but also the distribution over time can become quite large and hard to grok externally. Because you're like, how did you end up? Wait, you sell through like home improvement people, through auto shops, through cruise lines. You're like, yeah, we ran experiments. We found these.
That's right, and I think, I mean, sometimes you're in Silicon Valley and you're a bunch of engineers and product folks, and you're really sort of drawn to product innovation, and that's great.
Yeah.
That's a big part of our DNA. But I think it's great to combine that with some more traditional distribution, where the banks and finance companies have been thinking about this for decades. And have actually established very powerful, very sort of efficient distribution channels. And so in auto, for example, I mean, we're also thinking of like a lot of ways we can help people buy cars online, and there's been like so many experiments in that space. None of them has actually worked great so far. Carvana might be the closest, but others have failed. So selling through dealers is still what's working best today. But then you can combine that with other more direct mechanisms that sort of get you closer to.
Yeah, totally. And then the big distribution one that, as you start to really rescale, is just building a brand that has consumers naming stadiums or doing other things. That all kind of ties.
Right.
What's been really hard about I'm sure there have been a lot of things that are very hard about the business, but I think probably one of the hardest moments was early in the pandemic.
Yeah, I mean, the pandemic was such a special moment, and obviously a very sort of painful moment, with a lot of suffering for a lot of people. From a business standpoint, it was kind of this unique moment as well, where I think there was this like one day around like mid-March 2020, when like the same day the like Dow Jones fell 5 or 6%, one of the biggest one-day drop. Tom Hanks said he had COVID, and the NBA canceled the rest of the season. It's like one day.
It's not a good day.
Oh shit! Like something is really happening there. And I think for a few weeks, like it felt like we were like there was no roadmap of where to go. It was completely unprecedented. None of us had ever faced anything like this, where the unemployment rate seemed to be moving up.
The first 3 months was very unclear what was actually happening, even the first 9.
Right. And particularly these first few weeks, and then we're getting calls from all the loan buyers saying, hey, we don't know what's going to happen, so we'll stop buying loans. And so when you don't have your own balance sheet and you're relying on loan buyers, it means you stop making new loans. So we had to like decrease volume by about 50% within a couple of weeks. So very, very dramatic changes. But then the sort of government subsidies like started flowing in, and then they started to get,
which is good news and bad news for business to some extent, because credit quality goes up, but the government airdrops $1 trillion in stimulus. People they have balances, they don't necessarily need to borrow.
That's right. Yeah. So certainly, savings rates went up, but you
have a banking product, or a banking product was about to come online.
Right. Exactly. Yeah, you can make up for it. Or even, I mean, credit demand is always there to some extent. Even in cases where consumers might still have savings, they still use their credit cards, and they still it's not uncommon to have both like positive balance on your checking account and a credit balance elsewhere. So it took away some of the demand, but not much. But what it did was certainly sort of making it easier for people to pay their loan. And so credit quality went way up. So we went from a sort of credit quality falling off a cliff with the unemployment rate jumping to double digit in just 2 weeks, to like the best time ever to offer credit.
Yeah, absolutely. And do you feel like any of the changes you made during the pandemic have permanently changed how you operate as a business for the better now that you're farther through
So,
it?
I mean, I think consumer behavior changed forever, for sure. I mean, more people have got used to not driving to a branch.
Yeah.
Branches were closed. So
Yeah.
they had no other choice than going online, opening an account online, and transacting online. So I think that that change in consumer behavior is here to stay and has had long.
No one went into bank branches.
Right.
Which means they have to go somewhere else. They want to open an account.
Right, exactly. In terms of the way we operate, I mean, we had to become more efficient at the time, certainly to like save on cost.
Yeah.
So we focused on more automation projects that have had long-term effect.
Yep, totally. And for the future of Upgrade, already talked about the product, distribution experiments, but curious, long-term future, how do you go from 5 million consumers to 50 million? What does that look like?
Yeah, so it's really continuing to build on product innovation, to offer like unique products that provides responsible financing, affordable financing for consumers, but also have an immediate impact on their wallet. Like put more money in their wallet today, because you can't just doing the right thing for consumers in the long run is necessary and it's part of our culture, but it's not enough. You really need to have that immediate benefit that consumers can feel in their wallet. So combining, for example, Upgrade card and its long-term benefits with a sort of generous rewards program, and like having like 2% or 3% cashback rewards, like something you can feel every day, and you get this notification, you get like free money. It's great. It feels great.
There are other cards that have 2 to 3% cashback rewards. Almost none of them, though, have like real-time integrated push notifications and deliver on a consumer experience.
That's right. Yeah, it's not enough to provide that benefit. You need to show that you're providing that benefit and encourage consumers to focus on it and understand that's good for them. So I think we have the right setup to sort of continue to grow, continue to innovate, and get into more and more categories over time. We're really sort of having that ability to help our customers in like every important moment in their life. And certainly buying a car, renovating your house, getting on a trip, but also buying a house would be next. And certainly when we get into mortgages, then that sort of expands the addressable market. It almost doubles.
Totally. 12 trillion in mortgages outstanding versus 1.2 in credit card debt. Mortgage very hard, but I'm very excited to see you try and crack that nut. Another question, more broad. Audience has a lot of founders. What advice do you have for founders in terms of building a business?
Yeah, I mean, it's so something I talk about with entrepreneurs a lot. I mean, I receive a lot of presentations, business plans, opportunities to invest. And really what I look for in entrepreneurs, and I think the best advice I can give them is, it's not about your plans. I'm sure your plans are great. You found a good market niche and then you're going to go after it. And it's all going to be about execution. And I believe in you and you can do it. But at the end of the day, I mean, no battle plan survives the first contact with the enemy. Right? Things are going to change on you. And the market is going to change. The demographics are going to change. Competition is always moving and coming up with something. And if you're innovating, by definition, you don't know how people are going to respond to this because nobody's done it before. So I think the one single thing that to focus on is testing infrastructure and data, and like being sort of extremely data driven and responsive to data. So I think a really sort of good way to capture what's really happening, a good way to test, and being nimble and making these changes and really letting the market decide and tell you what people are responding to, what they're not responding to, in terms of message, in terms of product features, in terms of distribution channels. At the end of the day, it's all going to be about
big experimentation and data into the culture.
Exactly.
And the framework. Yeah. I'm curious, I think that's particularly true probably in consumer, where you have larger numbers of end consumers. Maybe less true, or true in a different way in B2B. I'm curious if you agree or have some.
Yeah, I mean, certainly it's easier on the consumer side because you get a more sort of diverse.
You have a bigger end,
right?
Would be
exactly.
One thing,
You get more data, easier to read. But I think it's also true on the business side, and maybe the way you get to the answer is slightly different, and maybe it's more conversations with your customers, as opposed to just looking at data. Because consumers are not necessarily going to know what they want. Right? You need to like put the product out there and see how they're using it, and the data is going to tell you what the need really was. With business customers, sometimes it's more conversations, it's more surveys, more like getting more qualitative rather than quantitative. But it's the same process. It's really about sort of putting something out there and then starting to iterate and eventually get to the right answer.
Yep, totally. Quick, fun questions. Underrated versus overrated.
All right.
So we're here in downtown SF, San Francisco. Underrated, overrated.
Right now, way underrated. It's going to come back.
Yeah, I mean, you can look around. It's a beautiful day right now. It's hard to beat for sure. 2, BNPL.
Appropriately rated.
Yeah,
I guess.
But,
I mean, it's a lot of excitement, but I think that's totally appropriate. I mean, there's a lot of power in turning a large price tag into a series of affordable payments. I mean, there's no question that it's a great service for consumers, and it's not a matter of applying it the right way, in a way that's responsible, and to the right product categories and finding the right distribution.
And your bias would probably be it's best done embedded into a larger product suite to talk your own.
Exactly.
Cool. Lending Club.
I think underrated. I mean, at the current price, so certainly. I mean, I think they went through this sort of big transformation of acquiring a bank.
2019 they acquired Radius?
3 years ago, I think
maybe it's only 2020.
Because they just got out of that. You have this operating agreement with the regulators after you buy a bank for 3 years. That slows you down a lot. There's a lot of things you can't do with the first 3 years. That just expired. So I think I'm expecting a lot of like good things to come out of it.
Yeah, I do feel like the consumer online lending category got really hammered. And to your point, even if it's not as ambitious as you might have hoped, it still can be completely underrated at the current market price.
For sure.
2, home equity and mortgage as product areas.
Mortgage. We haven't seen as much innovation as you'd hope over the last couple of decades. I think it's lagging behind.
I tried with a team. It didn't go well. It's very hard.
It's really hard. And frankly, I mean, the source of liquidity, right? Fannie and Freddie having their own sort of standard and buy box certainly is very useful, but also hinders innovation a little bit. So I think there's going to be more there. Home equity lines of credit also got like really bad rap after 2008, but it's super useful product that's coming back somehow, and Figure is a great example of that. But I think it's going to continue to come back, and we'll see more volume.
Yeah, I expect to see some stuff. It's hard, but it's a huge market, and it definitely needs work. Well, thanks so much. This has been an awesome conversation. I feel like it's great to talk about, why consumer companies matter, how you can build great consumer companies through product, distribution, capital markets innovation, all that. And thanks for hosting us in your beautiful office here in San Francisco.
Yeah, thank you. It was fun.
Cheers. Loved this conversation with Renaud. There is so much skepticism that anything in consumer fintech is working, but here you have a company that's got 5 million customers. They're going to originate $30 billion in loans this year. Upgrade has innovated on product. They've innovated on distribution. They've innovated on capital markets. And you've got a hungry founder who's just getting started. If you enjoyed this conversation, I've got a bunch of other interviews that you should check out, including this one. We talk to people doing important work across the fintech ecosystem, so I hope you'll enjoy those as well. And until then, catch you next time.